Happy Wednesday, everyone. Thank you very much for being with us for another session of RM Smart Investing. This is a day before Thanksgiving, so I just want to wish everyone a fantastic one. And there's just so much that we are grateful for. So today, we are, with the way the markets are, we are going to discuss, at least in my opinion, some of the greatest trades that I have witnessed, or I have, could be a little subjective, but also hopefully there's a little bit of objectiveness in there too. And also some of the most successful traders, and see how did they make their big money. And with that, with the markets being obviously breaking all-time records, and I think this thought comes to our mind, is there any way we can take advantage of this? Are they markets really overstretched? What is happening with cryptocurrencies? Every day you hear about these traders who make tons of money. And we've had classes, obviously, on the traits of the great traders. I thought, let's look at, I put a top 10 and see how did they make this huge amount of money, and what did they think at the time that they did. So with that in mind, let's start the countdown, and here we go. So I start from number 1 rather than going from 10 to 1. So I thought these are going to be, rather than just keeping me suspended. So it is in suspense. Number 1 is John Paulson's bet against the subprime mortgage. So it is 2007, 2008, and he made a huge bet about real estate and the mortgage, and he had the credit default swaps. And he, in my opinion, a lot of these trades that the traders that you will see, the trades, I've actually witnessed them. There's few that they go beyond my lifetime, but quite few of them, since I have the experience actually feeling what we were going through. And that's what kind of was a little objective and subjective at that time for some of you, but it was objective for me. So with his trade, John Paulson was really unknown. And then with what happened, he made, for his hedge fund, he made $15 billion in 2007 alone. And he actually earned himself about $4 billion. And as of last year, he was his net worth was at $4.2 billion. Interesting enough, in 2018, he was served for a $1.5 billion tax bill because of all the gains that he had made. What I wanted to do, so in this situation, you can see he was really shorting the market. So the mentality, and you will see there's a common ground. What I've looked at, there's a lot of times when the players actually had gone against the market, against the public sentiment, and they have taken that risk and gone against it. And this was one of the examples. Again, this happened at the pretty short time in a way. And again, my rankings have been based on some of the things that they didn't develop over many years, although I do have some. I've kind of put more weight on a more of a shorter time period, because that's why they are traders. So here was John Paulson. Then I wanted to look forward, and I say, okay, John Paulson made that great bet, but what his hedge fund has done since then. And I just want to share this with you. His portfolio since 2013, June of 2013, is actually down 47.8%. The value is at 3.5 billion. And the Sharpe ratio, which is basically is a risk-adjusted return, is at negative 0.81. So obviously we want to have positive. So he's actually, when you compare it to other hedge funds, you can see here that he's not only is behind what the S&P has done, he's behind what average hedge fund manager has done. And basically in this situation, this is where he stands. This is from 2012. And even with the big bounce from the March of 2020, with the pandemic era, he hasn't really had a big jump in his portfolio. I want to go one step further, looking at this moment. This is as of March 30th, 2021, his hedge fund, what they are holding, and basically some of his actions that he has taken in regards to his portfolio. Number two, if you are a fan of trading, I'm sure you've heard of Jesse Livermore. And he is actually still considered the greatest trader of all time. It's just his knack. Remember, he didn't have a hedge fund. This is his own money. He unfortunately, he had a very volatile personal life, but if you read the Reminiscence of a Stock Trader, it's a must for anybody's library. It allows you to basically see the views from a trader's eyes. And this is Jesse Livermore. So another call on the market. So one call, we were in the subprime mortgage, shorting the market. The second, still, again, shorting the market in the crash of 1929. Now, what he did, he was actually one of the very few people who shorted that go-go 20s, and then he ended up making about $100 million, which is about $1.2 billion today. He also, in 1907 crash, he also predicted that correctly. So he was an amazing guy, but unfortunately, he died broke. So that's Jesse Livermore. The third person, again, this is during my lifetime, and I remember those days actually. It was George Soros's breaking up Bank of England, and that's what he did. His hedge fund, basically, he went and shorted the pound sterling, and this is the time there's a German mark or Deutsche Mark and pound sterling. He basically shorted that, and that was when Britain was think of joining the euro, and doing that, he actually made $1 billion, and that was one of the greatest in the currency trading. So I do remember when he did it, and I've read some of his books, and one thing I have to tell you though is Stanley Druckenmiller. I think that was his partner who actually came with the idea. So it wasn't all his. There were other people who were actually shorting, but one thing you will see, the common things, they really had that fortitude and the courage to go and do what just they did. And he bet big, and here he is. He made over $1 billion. So when we talk about currency trading, he was one of the, this was one of the biggest. And I'm going to look at the Soros fund management. This is, again, I thought, well, let's take a look at what he has done. So he's done 9.8%. The Sharpe ratio is -14, and this is just for your own information where he stands, which is not him, it's like his fund, and the fund value is at 5.42 billion. And basically some of the activities he has had in the last quarter. Basically, that's the latest information that I have. Number 4, and I lived through this as well. So that was Paul Tudor Jones's, that the famous, I was a young man in the trading desk or investment desk. And I do remember that day, the Black Monday, October 19, 1987, the Dow Jones dropped 508 points, which was the largest, and especially with the percentage-wise, it was the largest drop, 22.6%. And Paul Tudor Jones actually, again, he shorted, he had been telling about, there's a crash coming, and he actually took action and shorted, and he made obviously a big return. He made as much as $100 million that day. So he's one of those people. I followed his strategy. He's a multiple talented. I mean, he invests in everything, trades in everything. One of his fames, besides he has Robin Hood Foundation, which is a fantastic, charitable organization or foundation. his Christmas holidays, the light show, and his decoration of his house in New York is one of the amazing things. So if you have a chance, watch a video of his Christmas decorations. So he's famous for that, but very well respected. He's still active. He's had a lot of ideas about the cryptocurrencies and the Bitcoin. So it will be interesting person to follow if you're serious about trading. One of the things I would recommend, and I remember many years ago I found this. It was, I think it was a South Korean finding on YouTube many years ago, and it was actually a video of him trading in that, in 1980, during the 1987 crash. And remember, we don't have all these laptops and all these monitors and very fast trading. Everything is done by phone. He had the computer. It is a fascinating video if you are interested in trading. And I remember, I was younger and I watched that, and seeing the motions that you go through during the, these ups and downs with the crude oil, what is happening, and then the stocks, and his whole behavior, and his composure and not composure. And again, that video was off for a long time, but now you have this. It is available now. It's a documentary movie called Trader. So if you have a chance, please go ahead and watch this. Number 5, again, I remember it's a lot of these things I remember vividly, because again, I'm that old. So it is David Tepper's, the 2009 bet on financials. I do remember seeing David Tepper on CNBC on March 10th, if I'm not mistaken, right at the bottom of the market's financial crisis. I think S&P was at 666. And he actually, CNBC loves David Tepper, and he actually came and he said, this is the bottom. And it rang in my ears. I could not believe it. And you go back, last 12 years and see how correct he was. So he made a bet on the financials from Bank of America to, I remember it was under $3, and I remember Citigroup was under $1, and he just, it just took off, and he was absolutely precise. And this was more of an opposite. We can see a lot of these traders, they make them on the extreme movements. So sometimes I'm asked about, the trend following, and I'm as a person, I'm a contra trend trader. And you see these things when that elastic band has been really stretched, that's when the most money has been made. So David Tepper was fantastic. He is a very good, and he continues to be a very good hedge fund manager. Now, what he did, he made $7 billion, and he actually personally made $4 billion. And so that's on the opposite side. So he looked at the valuation and he went the other way and started buying while everybody was negative. I thought, let's look at his Appaloosa fund, which is up 177%, and it's manages about 4.2, and you can see he has a Sharpe ratio 3.01. Average return has been 21.1% in the past 3 years, and as you can see, he is way ahead of average hedge fund. And you can see from 2020 bottom, look what he has done. So basically, that's the performance. The interesting thing is, a lot of these things, you see how the S&P 500 has so far has beaten all these hedge funds. So just a food for thought. But again, he's very well respected. These are his last activities as of last quarter. So I thought to share with you, and some of his holdings, the reductions, the additions. So that's David Tepper. Number 6, if it were up to me, in a sense of the most respected fund manager, and again, we're talking about traders, but it's all about the vision, the visionaries. I mean, John Templeton is my hero as a person and as an investor and trader. Again, someone contrarian. He got in. Some of the best things that, as far as the books I've read, has been, about his life as a person, and um, what a human being he was. But also he was way ahead of his time. So in 1939, for instance, he got and he borrowed money. I believe it was a little over $10,000, and he put $100 on each of 100 for U.S. stocks, and they were trading in below $1, and he just quadrupled that account. So he's a very value investor, and he was looking at opportunities, and he is the father of the global investing. So in 1960s, he basically ended up investing in Japan before there was any movement of this big growth happening in Japan. As a matter of fact, as a young child, growing up, in 1960s, I remember, we used to make fun of anything made in Japan. It was like something that, it's obviously anything made in like United States was golden standard. Anything made in Japan, it was a copycat. And look what happened. So basically, he was again a visionary who boldly, moved in way ahead of everyone else, and he invested in Japanese assets, and he paid up tremendously. Of course, he had the Templeton funds, and the rest is history. Number 7. This is more not to do with commodities. So we can see we've had the real estate and mortgage-backed securities. We've had the stock markets and international investments. Now, Andrew Hall, he made a big prediction about oil. And this is in 2003. And this is right after, again, we had the recession, we had the internet bubble. That's after 9/11. And he was looking at oil being at $30 per barrel, and he made a wager, and he said, in the next 5 years oil is going to go to $100. And at that time he was working with Citigroup, and guess what, in 2008 oil had gone past $100. And in this situation he made a very, very good trade for his, obviously for Citigroup, but also he was awarded a nice chunk of money, about $100 million. So number 8 is Jim Chanos is, he's called the best short seller in the world. And, this is in 2000, 2001, with everything going on, he boldly came and actually started shorting from Tyco to, he predicted Enron's demise. And so that's how he became very successful, and he's made a lot of money. And interesting thing is, when you compare to everyone else, you can see his fund is up 314% with a very nice 5.47 Sharpe ratio, although it's the value of portfolio is very small, so it's a little easier to manage that. He's had a compound interest of 32.65%, and you can see what he has done from bottom of 2020, March of 2020. Again, some of his activities, what he has done, just for your information. Number 9, again, someone that I followed, very interesting character, Jim Rogers. Jim Rogers was a partner of George Soros in the 70s with the Quantum Fund. And then later they went separate ways. And I've really am a big admirer of him as a macro cap. I mean, if you have ever chance to want to read a book about commodities, but also the global or the macro economy of the world, he has written 2 books. He's the person to watch. He lives in Singapore. His children both speak, they're very fluent in Mandarin, and he is a big believer that you should learn Chinese language. And actually couple of the my students, actually, they have sat with him. They've gone to his office. They know him. So it's a very exciting person. And he is someone that he has traveled around the world. He has a book, he has actually two books about his biking, using a motorcycle, traveling around the world, and then using his Mercedes with his spouse to be, or at that time, I think they had just been newlyweds. They had traveled all over the world. So he has a very good concept about how the macro forces work. And he always admits that he doesn't have the crystal ball. He doesn't know what's going to happen in a month or 6 months. He doesn't like to make predictions, but he looks for really valuations that they are extreme, and he likes to get on board much early, and that's what he did in 1996 and 90s. He got into commodities. They don't actually happen immediately, but then he made a killing in the next few years, and that's actually, there are Rogers, if you have ETFs you want to use for the commodities, he has his Rogers commodities ETF. So it is one of the, again, this is long in commodities, and he was one of the first ones to call it. Number two is Bacon's Persian Gulf crisis play, and he made tons of money basically knowing that, was anticipating when Saddam Hussein invaded Kuwait and what will happen with the oil. So he shorted the stocks, even though it was short term, and then he went long on oil. And in this case, he made 86% that year. And then he made bets on, again, the short war on Iraq. This is 1991. In January when it happened, it was I do remember that day as well. So this is another commodity play. So you can see a lot of money were made, again, very contrarian, the things that happen very quickly from the markets, and everybody's, the sentiment are in one way, and then the plays that some of these investors and traders have made the other way. So it's the courage, it's the conviction. They did do their study. It wasn't just a luck. And again, but sometimes we have a one-hit wonder kids too. I didn't want to use that, even though John Paulson, again, if you have seen the movie Big Short, that's him. And that's, you see, again, he was courageous to do that, although his performance hasn't been that great. That's a lot of pressure on him. He had I think 3 losing years in a row in 2016, 17, 18, I believe, or no, 2018, 19, 20. So anyway, but that's as far as that. So I want to share this. This is coming from, I just want to now share like some other sources maybe, and this is some of the greatest hedge fund managers around now, the 7 best traders in the world. And this is as of last year. So from Jim Simmons at, the Renaissance Fund. He is a magnificent brain, I would say, mathematician, and what he has done with his technologies, and really one of the first people who automated, in a sense, using the quantitative analysis and the math. And we will discuss him a little later. Ray Dalio, of course, is the largest hedge fund in the world, the Bridgewater, and then Carl Icahn and Steve Cohen, which is not, and obviously he had some problems with SEC, but still he was bright. And Ken Griffin, David Tepper, we just spoke, and George Soros. So these are, as of 2020, these were considered the 7 best traders in the world. I went one step further. I looked at the 2021, and we want to see who are the top 15 richest stock traders in the US. And basically, Warren Buffett, Jim Simons, Ray Dalio, Carl Icahn, David Tepper, Ken Griffin, Steve Cohen at 14.6 billion, George Soros 8.6 billion, Israel Englander, David Shaw, David Siegel, Chase Coleman, Paul Tudor Jones, Bruce Kovner, and Stanley Druckenmiller, and that's 4.4 billion. Now, reading what I just read, that's why I still enjoy reading the Market Wizards 1 and 2. So there's a lot of, there's few of these people, there's a reference to them. So I would encourage you to read those. Continuing with our, I gave you a new list. So here's Ray Dalio, just tell you, although, that manages this fund is 18.26 billion in size. What is the average return? Still the positive 1.98 ratio. And these are like some of the, you can see just on the average what hedge fund manager has done. He's very much believes in multi-assets, a lot of correlations analysis. He's involved in everything in a sense. So that's how he finds the anomalies and invests in them. This is his portfolio. I thought to share that with you, what he has done. As far as Carl Icahn, I just mentioned, again, his portfolio, where he stands, you can see he's underperformed the hedge fund averages and his activities as of last quarter. Bill Ackman was not there, but I remember, when Bill Ackman had actually in February, he's famous for, saying that you get a short, and then in March, right, again, the bottom, March 23rd, somewhere around that time, he said he's going long, and that's about this right around here, and the rest is history. So it's something about Bill Ackman and his Persian Square Capital Management I thought to share with you, and again, some of his holdings, and you can see everything has been added since the last reporting as far as September 30th. Last but not least, is about Jim Simons. Is, again, it's amazing person, again, very smart man, and he's very philanthropic, and he's done a lot for the investments and his surroundings. Again, he was very much in the quantitative side of things, very much mathematically oriented. He got his PhD at age 23, so just gives you some ideas. And then he founded Renaissance Technologies. Want to share this though, with all that brain, we are not invincible. He's been doing great. So his medallion fund in 2020 was up 76%, but his other funds that these other the medallion fund was closed to new investors. The other ones which were open, he lost 22.62% in his institutional equity funds, and the other one was institution that the diversified alpha was down 33.58%. So, and so it's two extremes. That 70 was the best ever. The other ones were the worst ever. So again, it's a difficult thing to be consistent and to be up there. And it's a challenge, especially as your investments and trading grows. So that's why when we talk about trading, for me, it's all about position management. And if you can start making sure that your psychological barriers are all clear before you full-time getting into trading, and just make sure the belief system is there and the courage and the convictions are there. One last thing, I just thought this was interesting that some people have put down, basically year by year, 2007 was similar to John Paulson, Peter Schiff, went negative with the real estate. George Soros, as we discussed, with the Bank of England and British pound. Jesse Livermore, 1929 crash. Simon Cowell with the bets, in the internet bubble. And then Paul Tudor Jones, the stock market crash. John Paulson, the same we just talked about the subprime mortgages, Jim Rogers, and the commodities boom. Now, Nick Leeson, this is notorious one, the man who brought Baring Bank down, the trader in Singapore working for the Japanese firm. And it's amazing, 300-year, I think, firm of Barings with one trader. I think it was 34, so a young man, and single-handedly brought everything down through not watching the risks. Risk management was the key. Nicholas Darvis, he is one of the greatest stock traders. If you ever want to watch or read a book, I made $2 million in stocks. We do have actually indicator, which we use, Darvis indicator. It's 1957, and it's equal to 1970. So I thought that's just share with you. The last thing I want to share, because in those performances I mentioned Sharpe ratio, so I just want to give you a little more understanding of what Sharpe ratio is. It is, one of the ways that we can analyze the performance of a portfolio. It's not that completely the best, because sometimes it is subjective in a way because of with the standard deviation and the risk-free rate. So sometimes we want to look at the downside risk, and the standard deviation goes both ways, right? So it's volatility could be on the upside, could be on the downside. So it's not 100%, but this is one of the accepted ways of analyzing a portfolio. So the reason is, if you're taking a lot of risk, obviously you could have a high return, but we want to make sure we are taking the risk in a controlled environment, in the sense that we are not taking unduly risk. So that's why this standard deviation comes in the picture. So it's your return of portfolio minus a risk-free rate, could be a short-term, money market rate, treasury bills, and usually it's, nowadays is 0.25, or where you put your money, what you're going to earn, and then the standard deviation of the portfolio, that's called Sharpe ratio. So obviously the higher the Sharpe ratio is, the better it is. So that means for the risk that you're taking, your returns are much better. Okay, so with that in mind, I appreciate your being with us. I hope this was interesting, hopefully stimulating, something that you can do your own research and perhaps come up with your own top 10. But these are the things that I found interesting and I wanted to share with you. So with that in mind, I like to stop the recording and